In today's video, guys, we'll be talking about ICT inversion fair value gap. What exactly is inversion fair value gap and how you can literally use it for trade entry? Now, for those of you who are struggling to understand some of the bulky videos from ICT YouTube channel, what I try to do on my YouTube channel is to basically help you to have a very basic understanding of what exactly ICT is trying to help you understand. So if you come to this YouTube channel, we basically have the ICT core basic, where I explain some of the very basic things that ICT explained, and then the intermediate, and then I'll work on the advanced level in order to help you to trade with the ICT concept properly. So let's get to this particular video. What exactly is an inversion fair value gap? Now let me start by telling you what a fair value gap is. We have the conventional fair value gap. A fair value gap is simply a type of price action where we see three candles that traded through each other, but then there is a gap or imbalance between them. Let me show you that. So in this three candle price action, you have 1, 2, 3, right? This is something very basic. This is the high of this candle, and this is the low of this candle. This is the high of this candle, this is the low of this candle. This is the high of this candle, this is the low of this candle. You need three candlesticks to be able to establish a fair value gap. So if that is the case, we could say that a fair value gap is this simple price action. You see, the first candle, you see this is the low of this first candle and the low of the third candle. If you are counting from upward down, let me put it correctly again so I can show you. So you have this, you see the low of this candle and the high of the third candle. If they are not connected, you are set to have a fair value gap. So the gap between the low of the first candle and the low of the third candle is what we call a fair value gap. And the color of the candles does not matter. I have said it time and again. Let me show you what I mean by that. So you see this 1, 2, 3. So you can actually have the first candle and the third candle as a different color candle or different type of candles, whether a buy candle or a sell candle. So what matters is the high and the low, because where the high of a bearish candle and the high of a bullish candle is almost the same. So the high is always at the top, you see, and the low is below. So the color of the candle does not matter. So that is simply what a fair value gap is. And how do we trade with it? When we find a fair value gap, let me give you an ideal price action. Let me sketch it. When you're trading in a bullish market scenario, when you have price breaking structure to the upside, boom, break of structure, right? That is a typical example of a bullish movement. And you've done your assignment correctly, putting your fib level from here to here, expecting price to start retracing into the discount area, and then you take trade. You see what is happening? You will target the PD-ARRAY. Mostly we will see a fair value gap right in the discount, and then we may see an order block. Mostly we will see a fair value gap or an order block. Let me take out this guy. So if this fair value gap is what we are expecting price to bounce from, so we will expect this fair value gap to actually push price upward. This is where we trust the fair value gap, and our entry for a long position is mostly there, and our stop loss is going to be below here, and we will target boom this side, right? In a situation where this refuses to happen, what I mean is that where this fair value gap could not stop price from moving downward, and price violated this fair value gap and went all the way downward, you know, coming like this. If price is coming back, we could use this fair value gap as an entry level. You remember your resistance turns support and support turns resistance, the olden price action trading system. All right. So this fair value gap will now act as a very important level for us to sell. So we call it an inversion fair value gap. It's the inverse of the conventional fair value gap we were supposed to have. So when price was moving downward, Now it got violated price move even down to this place, creating a market structure shift, MSS, right? Now that price is coming back upward, we expect it to bounce from here and then we go downward. It's as simple as that. So I have an example right here to show you. Look at this particular price action. Very simple and straightforward. Price was moving up. Boom. We had a shifting structure right up here. We have it like this. Price was moving up. Retraced. Another boom. What are you seeing? A new price range has been created. The low of that price range is here and the high is here. Obviously, nothing is more than that. So we have a fair value gap here. What did we say a fair value gap is? Is simply an imbalance. We have this one and this guy. So what do we do? If price was to come down, let's see it right here. If price was to come down, we were supposed to go bullish from here. This is how we take the trade. The middle of the fair value gap is called the consequent encroachment. So we take our trade from the middle of the fair value gap. You either put your stop loss below this other block or even below the fair value gap. But I mostly put it below the low that was formed so that I don't get screwed. I do my money management subsequently from what I am having. All right. So what I have here is for me to see price got rejected here and then I go up. Let me show you what happened. Boom. You see? The fair value gap got violated. Price stopped me out. So all hope is not lost. Why? Because price could give us another opportunity, because after this has happened, what you have here is simply a shift in market structure, right? Market structure shift that is telling you that no, price is going to start going bearish. And you have this fair value gap now as a point of entry. So this becomes an inversion fair value gap. This guy, it is what we call an inversion fair value gap. So what do? We can take our trade from this now. Our stop loss is obviously, we'll target a very good area and we expect price to be respected around this inversion fair value gap. It's as simple as that, guys. Very simple and straightforward. You could see how price is going to go back up to that area. You see, price is going to go back to that area and give you the exact entry you expected. So price is now tapping you into the trade. It took you some time anyway. This was close to the end of a New York session, so you would expect price to slow until the other day of trading. And you see, what did you have? The inversion fair value gap worked as expected perfectly. This is what an inversion fair value gap is all about. If you go through your chart, you will actually see so many examples. Let me see if I can see another one. So look at this particular scenario again. We have a perfect price action. Price went up, trading into this area. This is something we are seeing. Price traded into that area, and then we are having price coming back to create a shift in market structure down around this area. Boom, we have a shifting structure, right? Now, what you have around this area is price coming back to this fair value gap, which is supposed to be a nice area for the short here. Boom. All right. And you're obviously going to target somewhere below for your target. I'm going into the very basic of these things because I will do the advance of how to take trade with inversion fair value gap subsequently, but then this is going to be a little bit of intermediate. All right. So what I'm waiting for is for price to tap me in, and then I will expect the sell. Now, what happens if price, you see, price got me removed from that, violated the fair value gap, and then price is coming back to the fair value gap again. All right. This fair value gap became an inversion fair value gap. A very basic understanding of that. What do you see there? From there, you have a bullish price movement. So you could try to go through your charts and see if you can see some examples that you can spot easily. Please try and do it so you can have a better understanding of this as you practice more and more. Anytime a fair value gap got violated, it could be used for something good. It's called inversion fair value gap. All right, guys, thank you very much for this. If you have any question, let me know in the comments. See you in another video.